I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group. So one of the trades we looked at today in our Market Taker Live Advantage group coaching class, which is a daily class in which students get trade ideas every day, was in Goldman Sachs. Now, Goldman Sachs recently broke above its 200-day moving average. There's really nothing but blue sky ahead, although in this market I'm not looking for a huge breakout to the upside, rather some tepid upside continuation. So in this scenario, I decide, well, what sort of strategy is appropriate for this kind of trade? And I need to do a little bit more research. Because I'm not looking for a humongous breakout to the upside or anything like that, just simply, as I stated, a tepid continuation to the upside, I'm not really interested in going out and buying a call outright because I risk too much. So what I would like to do is I'd like to hedge my risk somewhat. I'd like to risk as little as possible, and I can do that by using a call debit spread, specifically the June 205-210 call debit spread. Now, I like this call debit spread because it reduces my cost as compared with simply going out and buying a June 205 or even 210 call for that matter. My risk is lower. Now, this limits my upside somewhat because if the stock is above 210, I stop getting further appreciation on my trade. Now, I also like the debit spread compared with other trades, like for example a put credit spread, because implied volatility is very, very low. When I put this trade on, I get a very, very small positive vega. That means if implied volatility falls, it would hurt me, but implied volatility is already very low, so I don't anticipate it falling. If anything, it might rise, which would help me somewhat. So the way I would trade this is simply buy that June 205-210 call spread for about 215 or better, or lower, and hold it until pretty close to expiration because debit spreads like this need some time in order to appreciate and come to fruition, getting close to its maximum profit potential. Now, speaking of maximum profit potential, if I can take 75% of my maximum profit, I would close the trade early and move on to the next trade, and I'd be very, very happy with that. If, however, the stock moves against me, I would definitely close the trade early and not see my entire $2.15 premium be lost. Instead, I would rather sell this trade if the bull call spread that I'm talking about here gets down to $1.75 or less. I would close the trade and take just a small loss. So therefore, my risk reward becomes really good. I'm allowing myself a very small loss and allowing myself a pretty substantial leverage profit. This is Dan Passarelli of MarketTaker.com here on the floor of the CME Group, and you can learn about this group coaching class by simply visiting MarketTaker.com/GC. Trade well.